Hello. Welcome to Now Stock Trades. Hope everyone is doing well. I am post-call. I'm so tired, but I was able to have some form of sleep. So there's a lot to talk about. Literally the time I'm, doing the whole call thing and busy, we have some action for Clover here. So, just maybe I should just keep working hard, and maybe that might be some type of pattern here, right? So, first off, to all the haters out there, shut up. You know what I mean? I'm just kidding. Okay. Sorry. I had to say that because, we've been working hard, and this company has the ingredients to being a multi-bagger. And we're starting to see this come into fruition. Again, a lot of these investors, they don't really check LinkedIn too much. More institutional investors potentially might be doing that. But overall, Wall Street doesn't really, Wall Street's not that smart in terms of coming onto something. There's like two types of Wall Street. There's the public Wall Street and there's the private Wall Street. Private Wall Street's very smart. Public Wall Street, people that you hear in the media, they're purposely stupid, right? So they do this on purpose, again, because if it was all publicly out there, then everyone would be everyone would have the same opportunities, and we know in the world, sadly, that's not how it works. But overall, I just wanted to show you Andrew Toy's comment today. We can go ahead and read it together, and then we're going to go ahead and do an intrinsic value, do a couple of them, do a linear progression analysis. And the reason why we're redoing this is we're going to use it as the SaaS, like utilizing a SaaS revenue multiple, right? So I'll explain that by looking at Humana and then Palantir. Sorry. This is Humana and this is Palantir, right? Because they just recently became publicly traded, so there's not a lot of history here. So this is Palantir, and specifically what I'm going to talk about is the revenue to free cash flow, right? So normally, if you don't remember, I usually take a 5% estimation of free cash flow, but with Palantir, it's actually a lot higher because with SaaS, there's not a lot of operational expenses and costs where there's not a lot of overhead, so you get to keep more of the dollars that you bring in the front door, right? Which is called revenue, which again, if you understand that, most people don't even understand the basics. So let's go ahead. And before I do that, I just wanted to show you a nice graph. I think this is it. Let me just double check. It's okay. Fine. I won't show you. It's stupid anyway. All right. So let me go ahead and look at the questions here. I just want Roaring Kitty to tweet a clover leaf. That's all I ask. But honestly, he doesn't really have to, right? He doesn't really have to, because the fundamentals of this business is so strong that we're not like, there isn't a hope, right? There's no wishful thinking and hope. The trend is there. PPO plans are becoming more I've said this so many times, right? I'll say it again, brief, if you want, watch my past videos. But again, PPO plans, guys, they're becoming popular, right? They're going to become the dominating plan. 10,000 Americans are turning 65 every day. These Americans have a lot of chronic health issues. They're expensive. Insurance providers for far too long have been using healthy people to offset the sick people, and they can't do that anymore. They actually need to start providing real health care, right? And and pretty much unshackling physicians from to do their jobs. And I think they're going to step backwards. So this goes right into essentially what Andrew Toy was saying. So we'll go ahead and read it. So he's at the Bank of America Healthcare Conference, and he's just basically talking shit. He's like talking smack. He's like, Aetna and Humana are being very clear right now that they need to prioritize margin and profit. Now, interestingly, he's in this meeting 10 hours ago, posted it. I'm curious to know, what is the Humana stock right now? Did it, what's going on? So Humana's down 26% year to date. I always like to do this to compare. Alignment Healthcare is down 16.96%. UNH is down 4%. But interestingly, if you look at CLOV stock, because I was expecting it to fall down, because you can't, Like United Healthcare is the Beverly Hills of healthcare, right? Maybe if you want to like like let's I don't know how to explain this to you guys. Let's just say we all live on one street, right? Let's call this like healthcare street, right? Everyone has different houses. Some people have bigger houses than you, and those houses have security, they have gates, they have a moat, they have an earthquake system. So like United Healthcare's house is pretty strong, right? So that's why it wasn't able to get that much hurt. So negative 4%. Humana's house, they didn't build it that resilient. So, negative 26 for them. And then this one's negative 16. And Clover is weird because, they like have like the software around their house, and the software, can do some cool stuff. And, but they're down negative 1.37. There were positive 5 to 6%. I was watching that one. It went up to $1 and some change here with a little mini meme surge, which I don't like the name of that mini meme surge, which I already talked about on Twitter. But for some reason right now, Clover is still ahead of United Healthcare. And again, it's not the type of ahead I want, because it's more of a meme stock being ahead. And again, I'm more, again, I'm a long-term investor. I want people to see that. I want people to see this as not a clown company, right? And again, that's where the opportunity is, because I don't think it is a clown company, right? Okay, so, oh my God. All right, well, where do we go? Okay, so if we go to AMC stock real quick, you can see how within a month, not even a month, guys, 5 freaking days, it shot up more than 100%. It shot up like 277%. $900 million or more was added onto the stock. Sorry, yeah, almost more than $1 billion was added. Right, so it shows you how fast these types of stocks can go up. And it shows you how irrational Wall Street is, okay? So you can see how it can go hard from the bottom end. It can also go up hard from the top end, right? Especially when, the thesis is established. So overall, Clover's is on people's radar now, okay? In short. Okay, so let's go continue. So they're trying to prioritize margin and profit restoration in the next few years, and they will slow growth and even shrink in order to do that. I would assert that they, chased growth in the PPO market. So I really like this word. So chased, I would say the way I understand this, it's like correct me if I'm wrong, but I was saying, from my understanding, I think what he's saying is, they pretty much used up all their growth. Now, again, I could be wrong here, but I think that's what he's trying to say here, right? So, which has become very popular, or maybe, I don't know, maybe they're just, focused on that, but fundamentally lacks the care management capabilities that scales broadly across such broad range of providers. They just don't have the real estate. Now, what I'm trying to say is they don't have the software capabilities, or let's just say their siloed system is just not prepared to handle the influx of elderly people. That's what I'm trying to say. Sorry, I'm post call, so I'm just really tired. So the care and network management. And by the way, for people that don't know what post call means, because I sure didn't know what the hell this word means before I started to learn about it. So I was on call for I was doing about 30 hours. So I was doing about 30. I was awake for 30 hours. So I slept for maybe 10 minutes out of that. And I slept on my chair. But yeah, that's why I'm a little tired here. So the care network management capabilities they do have also aren't agile enough to react to many MA program changes that have come down recently, especially from CMS. CMS is ramping up a lot of changes, and their slowed, webbed, old system is just it's what they built in the 90s was great, but the thing is they're just so slow to it that a company like Clover can just within a software update can change the whole thing. All right, this is why there's a multi-year path to recovery. Okay. We at Clover, however, do have the necessary tools. Okay. This is the world for which we built Clover Assistant technology. This is where Vivek saw kind of the switch. Okay. about 10 years ago when they started Clover Health back in, I think, 2014, right? Again, I'm not reading that. I just found that came from my brain. Okay. So as such, now I'm reading, Andrew here. As such, I'm getting asked more and more why it wouldn't be a smart way for Clover to grow by allowing, Clover Assistant against CA providers to use CA for any payer. Okay. That's a big deal. Okay. So essentially, all those testimonials that you saw of those people, by the way, please comment down in the comment section. Once I'm like done reading this, I'm going to go ahead and read down the comment section. So it's not like I'm ignoring you guys, again, just, I only got like one head, so Clover to grow by allowing, so that's a big, I'm going to repeat that again, right? Clover to grow by allowing, Clover Assistant providers to use Clover Assistant for any payer. Okay. So I'm going to like translate this in like my language, right? Clover Assistant is about to let other doctors be able to say, I want to use Clover Assistant, not just for Clover Health patients, but also for Humana or United Healthcare patients. They're going to be able to use it for any payer. Okay. That's a big deal. For all those people that you saw in the testimonials, they just don't see Clover patients. They see Humana, United Healthcare patients, other healthcare providers. Okay. And here it is. And here's the next sentence. And even to bring Clover Assistant to markets where we don't have a Medicare Advantage plan. So that's huge. Okay. That's huge. What does he mean by that? Right. And even to bring Clover Assistant to markets where we don't have a Medicare Advantage plan. Interesting. So what does he mean by bringing it to markets that don't have an MA plan? Is he talking about the ACO again? Because that was failed. But what are they talking about here? Because they were taking on, this is different, right? This is the software part. Okay. And again, it's harder for me to kind of read between the lines here. So you're not, if you're like kind of confused, it's okay. Because I'm kind of confused too. And that makes sense because people like us that are in kind of the Wall Street of things, my coworkers and I love you. Hell yeah, man. No, I love you guys too. I love you too, Patrick. So I just saw that was in caps. Just kind of popped my eyes there. But hold on, Michelle. I'm live right now. Okay. All right. So I had to tell her. She's like, squealing, talking to the dogs. I'm like, okay, can you squeal later? I know the dog is, dog is cute. So, but yeah. So, I want to. So people like us. Sorry, the dogs are I'm sorry, guys. The dogs are barking. Hold on, Michelle. Can you please, like, today's an important day. Andrew Toy finally used the ass word, right? The SaaS word, and it's a big day. Okay, so give me some time. Okay, let me tell the dogs to bark outside here. Okay, all right. So let's focus on this. So this doesn't make sense, and the reason why is because people like us are more focused on the numbers, right? That's kind of like, we want to see, he's saying all these things, but I want to see, show me the money, right? Show me the revenues, show me the action. Okay. So again, I'm not trying to be kind of, like a mean guy. I want to know, I want to see the number so I can calculate it, right? But we're going to do some estimations here. Okay. So let's continue. It's clear that the market opportunity is there. Of course it's there. Absolutely. He knows it's there. He knows it's there 10 years ago. Okay. And payers and providers need the help. It's true. So let's go ahead. And now he's finally given the answer. For God hell, all retail investors, oh my God, have been basically trying to say, dude, we saw you hire the VP of SaaS. You know what I mean? So like, let's, spill the beans. Enough. So he finally gives it to us. And the answer is yes. We believe there's a huge opportunity to bring the power of the Clover Assistant platform to providers to use with any payer. If I read this, I don't know, like, in your head, if you can like put Andrew Toy's voice in it, because I like imagine him reading this to me, right? So it would likely have much lower per life customer acquisition. That's kind of like how I think of him. He's very passionate, right? So it would likely have a much lower per life customer acquisition cost. And this is the huge part. So how when I do the estimation of free cash flow of 5%. You know what I mean? This is just for me from educational purposes. Well, because the acquisition cost, the operational cost, you know what I mean? That's expensive, right? But again, if you have better margins, then again, more of that dollar bill that comes as revenue can go to free cash flow, right? And if you go to ask Bill Ackman, everybody on Wall Street, who's actually understands Benjamin Graham, they'll tell you it's all about free cash flow, right? So then the Medicare Advantage plan, and we would aim to allow physicians to use the same tool for all their MA plans, a common request. So you put that there, like, hey, we've been getting this request, okay? Like this is like that's a big deal, guys. That's a big freaking deal, okay? Like I don't understand. I don't know how to communicate this to you because I'm like partially like just kind of zoned out right now and tired. But I don't know. Like I'm kind of monotone voice right now. But I don't know how to communicate this to you. Your dopamine in your nucleus accumbens, where it's responsible for your reward pathway now in your brain, it should be seizing right now, right? Your whole body should be quivering with excitement because the thesis is starting to become alive. Okay, maybe I was a little too academic, but I hope that kind of, you know what I mean? So because of our technology background, we aim to support per member per month SaaS-like recurring revenue models. So again, everyone's excited about this again. But again, he says SaaS, but hold on there. He says SaaS-like. He uses the word -like. It's a SaaS-like business model, okay? But it's that word "like" that I don't like. Does that make sense? Because so my question is, what's the difference between a SaaS model and a SaaS-like model? Because the reason why I care about that question is I want to know is what is the price to sales ratio revenue multiple between a SaaS versus a SaaS-like model, right? Because when I do evaluations, I'm doing a SaaS model evaluation, not a SaaS-like model evaluation. So what is a SaaS-like model evaluation? And the only way we're going to understand that is when we see the numbers, right? Okay. So I just want to, again, I want to, I want to always drill this down to reality, right? I'm excited, but I also am optic. I think who uses this word a lot? Dr. Fauci. I'm cautiously optimistic, right? A lot of scientists use this word. I'm cautiously optimistic, right? So that's kind of what I'm emanating, right? That's kind of what I'm thinking, right? So because of our insurance background, we'd also be very comfortable taking value-based risk. Again, that's pretty good. These are kind of the asset-like approaches that they're talking about. Okay. And most importantly, we'll be improving patient health outcomes by giving as many physicians as possible access to data and AI for the purpose of managing chronic disease. I feel the current market disruption is very much in our favor. More to come soon. Great. And I can't wait. And again, I just want to kind of zoom down here. Shout out to all my stock terminal members, my mastering stock market students. They went ahead and posted this guy's comment. This guy, I'm gonna like it, right? So this guy's a SaaS leader, right? What do you do for a job? I'm a SaaS leader. You tell that to any American, like, what's that? They're gonna think of something else, right? So he says, you're right. Care and network management capabilities in market are generally not agile enough, not just for said payers. It feels like a huge opportunity for Clover Assistant to partner with MA plans nationally. As MA plans continue to prioritize MCR, it will be interesting to see how they leverage the Clover Assistant or Clover Assistant-like technologies to create a high-touch environment. Very exciting. So again, guys, the word is coming out, okay? And Chase just increased their positions in Clover. Wall Street's coming back, okay? They're coming back, baby, okay? And again, if you were to talk to people a couple weeks ago, it was the old death and gloom, right? And then now, people are saying, "Oh man, I wish I got 60 cents. I wish I got that 60 cents." I was telling you, right? It was, it was book value, undervalued. But again, my opinion, take it as a grain of salt. Okay. So now that we went ahead and kind of broken this down, and again, I'm sorry for being kind of slow on this, but it's good to kind of sit down, talk about it, and have a conversation. Before I go forward, I'm just going to switch back to the comment sections. So, how you doing, Sean? How are you doing? Off topic, but what impact does the put call ratio have on outlook? Or, yeah. So, just drinking some coffee here. So historically, when you have a lot of, it depends if it's robo or lobo. If it's retail puts and calls versus institution puts and calls, there's some statistical significance that specifies otherwise, that when you have a high put call ratio, it indicates that the market's probably peaked versus, so it's, you got to use it as more, for me, a contrarian investor. Again, I like to do opposite of what the market does, right? Again, it's kind of weird because in medicine, they tell you go left, you better go left, right? Because if you don't go left, especially in the type of work I want to be in, somewhat the margin of error is very small, right? But in Wall Street, it's weird, right? You cannot listen to people because people lie, and this is business, and business is disgusting. And again, I just kind of break it down to make just do opposite pretty much, and you'll statistically have an advantage, right? So I would say I look at this opposite wise, but I need to look at specifically the put call for Clover. I think we have access to that in our stock terminal. I just need to put it in. If Warren Kitty will tweet for Clove, I would open a tuna can for it. Oh yeah, because he loves a little kitty. It's chasing it's chase or chasing. Oh, chasing. Ah, okay, sorry. Yeah, I don't really use that. Use those types of words. So they grew to. Yeah, I'm not smart as Andrew Toy. So they grew too fast with no foundation. Yeah, exactly. Yeah, that's what Humana did. Hey guys, stop. Okay, so I was talking to. So dumb it down for us. Yeah, no, yep, yes, sir. Confused plus confused makes sense. Exactly, right? I am gonna buy more. Come one lady SaaS is on the line. I read that right? So hello, doctor. Please fast forward the stock price. Oh, I know, seriously, right? But it's the harder the juice, the sweeter it is. You know what I mean? It feels good to end up being right, especially when everyone was like, "Oh, you're wrong." My finger keeps pressing the buy button. You see what I'm saying? The sentiment's changing, right? Maybe shared savings, but I agree, can't do any calculation until we get numbers. Yeah, I can only do the estimation, right? But again, it's not accurate, right? It's all speculation, right? So instead of using 18x, we can do half. Well, here's the thing. I'm gonna just use the SaaS. Okay, hold on. Let me be clear. And I didn't update this. It's kind of been a while. I need to update this. Let me see if I can find it. Un momento. Oh, Lord. Okay, yeah, I remember. So I go to media. That's why I go to media. Oh yeah, and here's a little book here. It's a very nice book. Okay, so little media here. Where I go? SaaS index. I'll find it. So look at that, man. He looks like a model. Look at those eyes. All right. Let's see here. SaaS. There it is. Okay. So I went ahead and put this graph together. This is called the SaaS Capital Public Index. And I'm sure it's higher now. I'm sure it's like a little higher. I haven't last time I calculated was back in December, 6 months ago, approximately. So the SaaS Public Index is around 6.94, upgrade to 7. So when we do our linear progression analysis, we'll use the price of sales of around 7, right? To get kind of an average, right? But again, you're right. It can go up to 11, 15, et cetera, even sometimes 20. And I think at some point 30 to 40, and that's overvalued in my opinion, right? That's some crazy overvaluation. Okay. So back to what you were saying here, SaaS 9. Yeah. Again, I like to kind of at least back it up by a bunch of data. Again, what the hell is this? This looks at all the SaaS companies and looks at the average. And again, this is not even as accurate because what's SaaS versus SaaS like? There's that word like at the end. Okay. So again, that like diminishes what the category of what SaaS is because it's like it, but it's not, you know what I mean? It's like, I like to eat vegan meat. It's like meat, but it's not meat. You get what I'm trying to say? Okay. Right. So Andrew Toy, give me some meat. Don't give me some, you know what I mean? But no offense to people that like vegetarian meat. It's fine. Or vegan meat. I don't like it. I eat it once a year. Salty. Okay, so hit the guys, hit the like button. You know, if you haven't done so, hit the like button, smash it. Um, I don't ask for a lot. If you don't want to, it's totally fine. But yeah, just hit it. If you're not logged in, don't even worry about it. You don't have time for that shit. So you know what I mean? It's like no time for that, right? But if you're there, yeah, hit it. Whatever. So, but really, it helps with like the YouTube algorithm, right? So, but really, we need to go. Yeah, exactly. Yeah, +1. Yeah, absolutely. If we bought 20K shares, the price goes to 20, we make 4. Yeah, well, that's what I'm saying. It's yeah, and you know, so you're gonna see the numbers here. It's pretty cool. Cool question to you, Al. Does Chamath still has? I don't know. It's like a 4.99%. So I don't know, but I think he'll be behooved himself to not go back in because he'll be stupid, right? Because the the system is changing, right? So let me go ahead. I got like a little notification here. Okay, nothing interesting. Okay, so let's go ahead and before we do that, let's go ahead and go to the screenshots here. So this is Humana. Let's take 5% of this, okay, and let's multiply this by 0.05. So you get around 5,400, around 5,400 of estimated free cash flow. So we know that Humane is being kind of squeezed right now. So I don't even think they even have that, but I may be wrong. So free cash flow, yes, it's like in the negative now. So let's go back to when they were like somewhat decent. So let's go ahead and look at 2019. 2019 was good for them, right? 64 billion. And let's go ahead and multiply that by 5%. So you get around 3,200, right? So yeah, 3,244. So you go estimation free cash flow around 2019 and 2019, you go all the way down free cash flow right here. So they're about 45, 48. So they're around 6%, maybe 6-7% of free cash flow, right? Above the 5%. So that's approximately the average, that's why I use 5%. It's kind of undervalued, but at this point they're struggling, which is why the stock's down 30, 25%, whatever, because again, it affects the free cash flow. And like I told you, it's all about free cash flow. So now let's go ahead and take a look at Palantir. Okay. So let's go ahead and do Palantir, but this time let's go ahead and multiply it by 5% to estimate future free cash flow. You're going to realize that you're going to get $116 million, right? But if you go to free cash flow, they're at 641 million, right? So you can see that it's not 5%. So let's go ahead and make it 10%, right? It's not 10%. I've done this before, so it's not 10%. Let's go ahead and make it 20%. Okay, we're getting there. It's 466. Let's go ahead and make it 25%. Okay, 583. Let's make it 27%. Okay, 630. So it's around 27% of revenue multiples. You remember how I take 5% of the revenue to estimate free cash flow? Palantir, you would go ahead and you would take 27. So I'm going to do two different calculations for Clover. I'm going to do a 15% and 20%. I'm not going to do 27%, right? But let's do that. That's on average kind of SaaS-like around 15, right? To 20. All right. So you could do 10 depending how conservative you are. But again, then we have different types of discount rates. So that should probably go ahead and fix the general equation. Again, if you go to Bloomberg Terminal, pay $2,000 a month, our intrinsic value is even more accurate than Bloomberg Terminal. How do I know this? I've looked at it, right? So, okay. So let's just go ahead and let's take the lower end outlook of 2024, 1.3 billion. Again, these numbers are in millions. We're going to go ahead and take 15%. Okay. No, we're not doing 5% anymore. Okay. So we do that. We get 195 million. We put 195 million. We're going to take it to 10 years into the future and discount back between, 10 to 15% discount rate using a 2 to 3% perpetuity model divided by the number of outstanding shares. But interestingly, though, we're going to go ahead and use 3 different types of growth rates. We're going to use the current growth rate if they were to grow as a SaaS like right now at 8%, and what's going to happen if they grow on the average, which is around, let's say, 25%, and we're going to go beast mode, which is 43%, which is right around Alignment Healthcare. Fair enough? Okay. So 8% here, we go ahead and we do 496. So by doing this, you can see by it basically growing 8%, you can see the stock price is around $7 as a bull case, which is a pretty accurate discount rate of around 10, right? Estimation of future free cash flow positivity when it becomes profitable. Yeah, we're looking at 7. You want to be a little safe, we'll call it 5. But you can see how that's like already 5x for where it is right now, 5 to 7x. So you can see the opportunity here. But again, this is an 8% growth rate. Didn't you recall with Andrew saying that they're going to turn on the growth machine? And guys, let's not have amnesia, right? They used to grow at 50 to 100% year over year. Imagine coming off of the profitable growth of doing that. But again, we're not going to do 50 to 100%. We're going to do the 3 growth rates, like I said. So now let's go ahead and do 25%. That $26, 18 to $26. That's not bad. That's pretty damn sexy, guys. Okay. Now let's go ahead and let's do kind of like how Alignment Healthcare is growing. Let's do 43%. $60 to $90. So are you starting to see kind of the situation here? And again, guys, listen, this is a bunch of bullshit, Al. I don't believe this. How can a stock go from, pennies on the dollar to, $90? Well, this one went from 72 cents to $300. I'm just saying 90, right? I'm just saying like right around here, right? Like right there, right? Anywho, you get my point. Okay. All right. So there's that. But now, like I promised you, let's go ahead and do a revenue multiple of estimation of free cash flow of 20%. So we'll do it here. We'll do it here, right? 20%, you get 260. So let's go to 8% now. I'll go back to 8% and we'll change it to 260. This is a higher revenue multiple, assuming that it's like full SaaS. It's like Dr. SaaS, right? So then that means it should be worth around $10 now if they get that type of revenue. Again, building up SaaS revenue is hard, right? Let's say they do the 25%. We're looking at 35. Okay. Let's go ahead and let's do 43%. We're looking at 120. Okay. So if I were to say something right now, and let's go ahead and kind of basically pull up this screen here, I would say, there's like pathway. Hold on. Let me just make it a little bigger. There's like pathway 1. Let me just turn on the, this so I can, so I can be clear for you guys. Pathway 1. There's pathway 2. And then there's pathway 3. So pathway 1, they don't become a SaaS. They're just an insurance company like Humana. Okay. We're looking at anywhere between, for me, $4 to around $8. I'll just say, screw the dollar signs. You guys know what I'm talking about. So 4 to 8, potentially 15 max, right? Long term, yeah. We're talking 20 years. Yeah, of course. So this is just kind of the, this is just like insurance, right? Now let's go ahead and look at, this is like with SaaS, but more specifically, we're going to call it SaaS half SaaS. Half SaaS. I like half SaaS. Okay. This one's going to be more of like a full SaaS. Okay. So remember how we said half SaaS, anywhere between around 20 to 90. And this one was around like 35 to around 120, right? If you don't recall, my old targets were around 40. Okay. So we're starting to finally get back to that vision that I was seeing, right? Again, inflation, all this other stuff. Again, CPI cooled down. That was great. We'll talk about that different video. Let's just focus on this right now. Losing focus. So you can kind of like, this gives you kind of the different but again, this is all speculation. But again, if you're going to go ahead and do it, I would say the worst case scenario, even though each of these have its own bull, base, and bear, this is kind of a summary of the bull, base, and bear. Okay. Very quickly here. Oh, and Brandon, yes, it is fun. Yes. Oh, and they just repurchased $20 million of their stock. Why would they do that? Why would they do that? Oh, because they know they got a big SaaS. You know what I mean? Okay. And yeah, this is fun. Yes, this is fun. When you actually back it up by science and actually do something that the billionaires have done, they don't teach you guys about. in the K through 12 system, yeah, it does get fun. Absolutely. Because we're not just looking at stock price. If you haven't realized this, guys, now, have I looked at the stock price? Not really. I'm just analyzing the numbers here. Okay. All right. So though Robert's son said something very important here. The way they're hiring, they will have two different divisions: business product SaaS model and insurance model. Abso-freaking-lutely. Remember, guys, who is their CFO? He came from Humana, the head of growth strategies. Are you starting to see the building, the castle that they're building for themselves? Okay. Insurance will help prop up the growth of SaaS. Absolutely. You hit it right on the knob. Okay. And more specifically, the insurance will help prop up growth in general. Exactly. Because that will be profitable growth. And again, we haven't even talked about it. What happens when they go to 3.5 stars and 4 stars? There's a lot of upside here, guys. Okay. Now let's just go ahead and do a linear progression analysis here. Remember I told you SaaS index is 7. So let's do the same thing here, shall we? So let's do, again, 496. Oh, no. Put in the wrong box. Sorry. Am I doing this right? Ugh. Sorry. Hold on, guys. Let me... Okay. So let's do a growth rate of 8%, like start from the basics. 496, and let's do 7. Is that fair? Like I said, 13 to 22. You can see how these numbers change, and they go all the way up to 29 to 49. That's an 8% growth. Again, guys, it's very hard to grow like that. You know what I mean? With a SaaS like. But again, if they go ahead and push 25, you can start to see 13 to 22 all the way up to 128 to 213. And if they go beast mode, which is 43%, which I don't think they will, that's like a diamond in the rough. That's like we're talking like, I don't think that this will happen with a 7x. Then we're talking anywhere between 22 to 820. I don't think that's too far. I would say if you were to average it up, I would say a good 15%. You know what I mean? Again, like I said, 22 to 90, which falls back in line with our analysis here, around 20 to 90, right? In our base case, this half SaaS, right? So again, I hope that you start. I'm trying to like think out loud for you guys, share kind of like my logic. You know what I mean? But anyway, that's what I was thinking. What else? Yeah, we talked about everything. I have little tabs here. Yeah. Well, I appreciate you guys watching the video here. Let me go ahead and take a look at this here. How many states there? You can look at their website: New Jersey, Georgia, all these other. They pulled out of Arizona a little bit in Texas, stuff like that. We do need to expand, and I think that's what's going to happen. That's what Brandon was saying here. The insurance will prop up the growth side. So, and we don't want Humana and United Healthcare. We don't want him. Yeah, I know. Yeah, if you ask someone else, they'll tell you, oh, they're going to buy us. It's kind of a little funny joke we have on the inside of the stock terminal. But yeah, I know. I think we're doing pretty good there. There's a lot of $20 million repurchase. Maybe that was a signal that to retail investors to say, hey, that $20 million repurchase program is like, hey, we got this ass. Okay, we're confident. So yeah. That's what I have, 38-minute video. Holy moly, guys. Oh, thank you for, sticking around here. I appreciate you guys. And yeah, so I mean, that's pretty much it, guys. This is, we're looking pretty good here. Lots of work, lots of analysis, but, we're slowly starting to see the promised land here, right? And the beautiful part is we don't need shorts, even though people are shorting the shit out of the stock, it's fine. But we don't need that to prop up the company. We actually have a good company. Okay. In my opinion, I think it's a great company. Okay. So that's all I have for you. And I hope you enjoy the video, and I will see you on the next one.